Good afternoon and welcome to the BBVA webinar on doing business in the UK after Brexit. I'm happy to welcome you all this afternoon to hear from our panelists on what's changing in the way Bulgarian companies are doing business in the UK since the beginning of this year. We are still expecting quite a few people to log in, so while we are waiting for them, we would ask you to take a couple of minutes to respond to the questions that you see on your screen. That will help us to get to know you a little bit better. Thank you for taking the time. Hello again, my name is Desislava Miteva and I'm the Executive Director of the British Bulgarian Business Association. I'm very happy to welcome you all to the BBBA webinar on doing business in the UK after Brexit. We as an association have been very active in terms of explaining the new rules about doing business in the UK and in Bulgaria as well, following the changes which became official in the beginning of this year. This is one in a series of webinars that we've been holding on different specific topics related to Brexit. I'm very happy to see that today roughly half of the people on the call are already BBBA members, the other half are non-members. If anybody is interested to learn more about our organization and how to join, you're very welcome to contact us, and we'll be happy to talk and see how we can support you with your business. Thank you very much for taking the time to respond to the polling questions. It is clear that half of you are already trading with the UK, and another 13% are planning to, which is great. I hope you will have a lot of your questions answered during today's webinar. We can also see that the majority of the companies attending today have members of their staff visiting the UK on a regular basis. And also 1/3 of the attendees already have an office in the UK, while another 60% don't have an official office, but they're still trading with the UK. This is very interesting information that helps us get to know the demographics of the attendees a little bit better today. Thank you for responding. And without further ado, I would like to open today's webinar, and if we can move on to the next slide. Thank you. I would like to thank all the annual sponsors of the British Bulgarian Business Association who are making such webinars reach you free of charge. Big thanks to Deloitte, Athlon, Cleves, Landmark, Bulgarian Insurance, AXA, and Novotel Hotels and Resorts Sofia. Next slide, please. Very quickly, I would like to touch on the webinar basics. I'm sure you are all already experts on webinars because we've been in this mode for about a year, but still very quickly to remind you about the rules of the call. You cannot use the chat. You can, though, actively use the Q&A panel to raise questions. We have allowed for some time at the end of the presentations for Q&A, and we have already received some questions in advance, for which we are very grateful. Hopefully, we will have many questions that we will be able to take today. However, if there are any questions that are left unanswered due to time restraints, our panelists have agreed to respond to them in writing following the webinar. Note that the webinar will be recorded and the link will be shared with all the attendees. So don't worry about taking too many notes. You will be able to refer to the webinar at a later stage and also to share it with your colleagues and partners. Without further ado, I would like to say that today's webinar is done with the support with the Bulgarian Embassy in London and the British Embassy in Sofia. And today we have with us the Commercial Attaché in London, Tanya Koicheva, and the British Commercial Attaché in Sofia, Tim Buisere. And the other people that I'm very grateful for accepting our invitation for today's webinar, and that will be doing the biggest chunk of the presentations during today are our members, Kambourov and Partners, and they are collaborating firm for Andersen Global in Bulgaria. Before I give the floor to Tanya to start with her presentation, I would like to invite our chair, Miroslava Alexandrova, to say a few welcome notes. Mira, the floor is yours.
Thank you very much, Desi. Hi, everyone. Dear speakers, dear fellow members, I'm very happy to welcome you to this webinar on doing business in the UK after Brexit. Whether you're a Bulgarian company currently doing business in the UK or you're looking to develop a presence on the market, I believe that you can benefit from the expert knowledge of our speakers who will answer your questions today. Now, Brexit is a fact. As much as we have clarity around so many issues, the profound effects of the UK economy and trade relations are of concern to many people. Albeit the considerable level of uncertainty, there are still many factors that make the UK a favorable environment for people looking to start their business ventures. I would like to introduce Mrs. Tanya Koicheva, Head of the Economic and Commercial Section at the Bulgarian Embassy in London, and Mr. Tim Buisere, Country Director, Bulgaria, Department for International Trade, who will provide a quick recap at high level on the changes that have happened since 1st of January. Then, as Desi already mentioned, the experts from Andersen and Kambourov will delve deeper into specific topics, such as the new rules for registering a company in the UK, business mobility, including short-term business visits, UK border controls and custom procedures. You will also learn about tax-related changes, delivering services under contract, UK immigration rules, GDPR, and DAC 6. Finally, I would like to express our gratitude to our speakers. Enjoy the webinar. I hope you will find it useful. Thank you, Desi.
Thank you very much, Mira, for the kind introduction. It's appreciated. Tanya, what a beautiful picture of the Bulgarian Embassy, and I particularly like the two flags. One of which is already standing a little bit outside of the UK, I guess, which is the topic of today's presentation. The floor is yours, Tanya, and thank you so much for taking the time for being with us today. We know how busy you are with all the questions that Bulgarian companies have for going forward with their business activities in the UK. I hope today we will be very helpful to all of them. The floor is yours.
Thank you very much, Desi and Mira, for the kind introduction. Indeed, the European flag is still standing and flying in the heart of London. we continue to do business with the UK, regardless of the fact that they have left the European Union. How is business done after Brexit? Perhaps I should start, Georgi, with a brief overview of bilateral economic relations so far, and your members and companies that do business with the UK, they are aware that the bilateral relations have been relatively good over the past couple of years. They have grown exponentially, both as far as imports and exports are concerned. Next slide, please, Georgi. Thank you very much. We are particularly proud of our achievement in tourism. In 2019, British tourists visiting Bulgaria reached over 400,000. And at the same time, the United Kingdom for the first time became investor number one in Bulgaria, with 360 million invested in various sectors, mostly ICT. However, 2020 brought a different dynamic to the relationship. Obviously, COVID had a huge impact on the opportunities of doing business, but still Bulgaria managed to export a very similar amount of goods to the UK compared to 2019, which I consider quite an achievement, given that consumption in the UK, like in all countries, has been naturally contracted due to the COVID measures and restrictions. January 2021 brings us a completely different picture of bilateral relationship, particularly trade. On behalf of Bulgarian exports to the UK, the drop of exports is 40%, and it is even more dramatic as far as UK imports into Bulgaria are concerned, 65%. This is quite a substantial gap, which is due to the new trading regulations that came into force on 1st of January. COVID has some impact, obviously, but given that we managed to sustain the trade in 2020, this dramatic decrease I can only attribute to the difficulties related to the new trading regime. They vary according to sector and according to product. The most drastic drop seems to be in the fast-moving goods sector, particularly in the food sector. The drop as far as UK exports are concerned is 75% in food and drink. There are various reasons that contribute to the decrease related to the customs processes. And Georgi, if we can please see the next slide. Obviously, the economic situation in the UK has contributed to the drop in trade, and will continue to do so in the next couple of months. Among G47 countries, the UK has marked the largest decrease in GDP of 9%. This is still not yet the final figure, obviously, but we expect it to be confirmed toward the end of this month. Currently, the UK is distributing quite a generous amount of support to employers and employees equally. But once the schemes come to an end, we expect a rise in unemployment. And all of these factors will inevitably lead to a much larger budget deficit and a substantial increase in the amount of debt to GDP. How is this going to impact Bulgarian exports to the UK? Well, obviously, it will be much more challenging if consumption is decreasing, if debt is rising. People will be cautious about their spending. So I expect that this will have a negative impact on Bulgarian exports in the next 6 to 8 to 9 months. Georgi, next one, please. The Brexit impact has exhibited itself in all the trading-related processes. The first most challenging operation for companies on both sides of the channel has been clearing customs. We had numerous inquiries, complaints, pleas of desperation from companies to help them go through the process, even those that had most of their documents completed properly and in greater detail. It turned out that on both sides of the border, IT systems had issues, customs officers had difficulties with the forms themselves. Gradually, this type of processes are smoothing out. But we spent January, most of January on the phone trying to help as much companies, both British and Bulgarian, as possible. Another glitch turned out to be the rules of origin. This item on the customs declaration turned out to be quite challenging. Also, let's not forget the customs clearance doesn't always happen at Dover. There are various import and export channels, and it seems that aligning the understanding of whether and how to provide the proof of rules of origin is still a challenge for some transport companies, from some delivery companies. The current rule is that you don't need the proof of origin, but some transport companies do expect it and do require it. So my advice to exporters and importers would be try to be as detailed as possible. The other area where we received a lot of questions is how to charge VAT on services. I'm sure our speakers later on will get into the detail of that, but there is a distinction between where the provider and where the consumer of the service sits, and whether it's a B2B or B2C transaction. The latest updates on sanitation and phytosanitary requirements I hope has been distributed 2 weeks ago. The British government announced the deferment of all the deadlines, 6 months plus, related to the requirements and control and checking of products from food and from plant origin. By all means, the information has been distributed to our exporters, and if there are future questions, I'll be more than happy to respond to that. Online trade. Again, the glitch here is the VAT. There is a requirement by the British government for small parcels up to 135 pounds coming into the UK for the trader to register for VAT. In the UK, this proved out to be quite a challenge for the small suppliers, although we are receiving reports that they're slowly getting their grips on it. And of course, some of them are giving up on this opportunity because it's turning out to be very difficult. Labeling and UK conformity marking is still not very prominent in our question and answer sessions, mostly because the requirement fully comes into force on October 1st, 2022. But it is still worth mentioning that after this deadline, all labels must include a UK address, be it the distributor, importer, or agent. No European addresses on products and labeling will be accept it anymore. There is a piece of good news that the UK will continue to acknowledge organic product certification from EU providers. So this is a relief for some of our food and drink exporters. But the most difficult, the most challenging barrier to overcome in the past 3 months turned out to be transport. Transport costs have gone between 2 and 3 times compared to December 2020, and this is quite a substantial detriment, especially for the small and medium-sized exporters, vis-a-vis importers as well. And also, we receive reports that groupage transportation has almost ceased. Whether and how this will be recovered, it is still early days to see the development of this process. And one last item in this rubric, the Brexit impact. A lot of Bulgarian service providers have initiated the process of registering a company in the UK so that they can continue with the delivery of their services to their customers. That proved out to be much more challenging than we expected. The bottom line is both myself and Tim and his team back in Sofia, our primary goal is to try to help as many British and Bulgarian businesses to continue to trade, to invest, to cooperate, regardless of the challenges, regardless of the new current situation. The problems of dealing with the UK after Brexit have been acknowledged also by the Bulgarian Ministry of the Economy. My team has been reinforced here in London so that we can be as beneficial and supportive and helpful as possible to the Bulgarian and the British companies. We will continue to promote Bulgaria as a reliable and trustworthy partner to British companies, although the challenges of COVID and Brexit are quite substantial, I would say. And hopefully, with the support that we provide, within a year's time, we will return to our regular, usual annual bilateral trade exchange of 1 billion euro and beyond. I think probably that will be it from me. Thank you very much, Desi. Thank you, Mira.
Thank you very much, Tanya, for sharing your observations with our audience. I have to concur that they're very much in line from the signals that we are getting from the business locally in Bulgaria. I'm sure there will be questions for you, but as I mentioned, we have agreed that all questions will be dealt with at the end of the presentations. So now I would like to give the floor to Tim Buisere, who is leading the commercial team of the British Embassy in Sofia. Tim, the floor is yours.
Oh, thank you very much, Desi. First of all, can you see and hear me well? Because I'm using my phone. I just want to check.
Perfect.
Yeah. Great. And in that case, hi everyone, I'm Tim Buisere. I'm the commercial attaché at the British Embassy in Sofia. And just following on from my friend and my colleague Tanya in London, I'd like to just continue briefly to set the scene before the experts from Kambourov and Andersen talk in more detail about specific aspects of doing business. I mean, as our chair, the BBBA chair, Mira and mentioned at the beginning, and Tanya has emphasized, Brexit may seem a bit daunting and problematic problematic in some respects. And I don't want to sound naive, but I do also think there are reasons to be cheerful and optimistic about the future relationship. So I just want to outline about 4 or 5 of those, and I hope that you'll be able to agree with me. And the first one is that we do actually have a deal, a trade and cooperation agreement, which was signed at the last minute, just before Christmas. And of course, clearly from a business perspective, it's not quite the same as being in the single market and the customs union. Inevitably, there are more barriers to trade, but let's remember, it is certainly better than having no deal at all. And I think above all, it gives a certain level of certainty for us, for traders, for citizens as we move forward. It gives us a basis of goodwill on which we can build. So I think that's very important. And the second thing I want to mention is that the deal does include 0 tariffs and 0 quotas, which is actually quite unprecedented for EU FTAs. Free trade agreements, subject to rules of origin, of course, which Tanya has already mentioned. And those rules of origin are of course, typical in free trade agreements to protect the countries from other countries from unfairly benefiting from the tariff reductions. And these rules of origin specify the minimum amount of content that must come from the UK or the EU for the goods to be considered to be originating from those trading partners. And this has caused some confusion with companies, but again, I think we are beginning to see that companies are beginning to make sense of what rules of origin mean for their trade between the UK and the EU. And the third thing, I think, third reason to be cheerful, if I may put it that way, is the rights of Bulgarian citizens in the UK and UK citizens in the EU are all protected under the so-called withdrawal agreement. And there are quite a lot of people that the people-to-people ties have never been stronger, actually. If you think about it, we have, I think, several 100,000 Bulgarians who are living and working in the UK. They've made it their home. They make a massive contribution to the society there. And I think about 250,000 Bulgarians have signed up for the so-called settlement scheme, whereby they secure their status in the UK and they can continue to live and work like any other citizen. By the way, they still have until the 30th of June to apply for that, as long as they were living in the UK before the end of last year. And what you may not know is that many Brits have also made Bulgaria their home, and we're about 11,000 as far as we know, and half of those have their residence documents for Bulgaria. Likewise, there are about 6,000 Bulgarian students in the UK, and amazingly, there are 2,000 British students studying in Bulgaria, typically medical students at various excellent medical universities around the country. So, very strong people-to-people links, which of course also help to facilitate business between us. Furthermore, it's easy for Bulgarians to continue to visit the UK. You can go for 6 months without a visa. And you can, as a tourist, you can visit family, you can go on short-term study, you can carry out business-related activities like events and conferences. Likewise, the other way around, Brits can come to Bulgaria for up to 90 days in 180 days. And if you want to work in the UK, there's a new points-based immigration system which prioritizes the skills that people have to offer. Now, as Tanya's mentioned, it is true that there are obstacles to moving goods across borders. We've seen that as companies have got used to the new rules, and that is very much reflected in the trade statistics which Tanya mentioned, and it is compounded by COVID travel restrictions and simply the economic impact of COVID. However, in our observation, based on the number of inquiries that we're getting at the embassy, that is beginning to settle down, I think. We've been doing a lot of work with the BBBA, with the Bulgarian Embassy in London, to try and prepare companies and other institutions for the changes. We've had a campaign called Keep Business Moving to provide information, and we've hosted a lot of webinars and so on. And I think that is beginning to have an effect. Companies are beginning to make sense of the new rules. And in order to help further, the UK government a couple of weeks ago postponed the decision, took a decision to postpone further import controls by a further 6 months in some cases to give companies more time to prepare. And I guess lastly, I just want to say we're optimistic about the future. We have an excellent bilateral trade and investment relationship. Trade has grown by 50% in the past 5 years, notwithstanding last year. And the UK is the 5th largest investor in Bulgaria over the last 15 years. And even as Tanya mentioned, the number 1 last year, which is great. So, you know, we've got a large and strong economy in the UK on the edge of the European Union. And we think there's a lot to offer in our trading relationship. We want to help Bulgaria to work on the opportunities presented by green recovery from the pandemic and working towards a digital economy. And of course, Bulgaria has an awful lot to offer in the opposite direction as well. And as Tanya mentioned, this is why we're here. We're here to help businesses, whether it's through matching up companies with opportunities, local partners, helping companies to make sense of the new rules. So, you know, please don't hesitate to contact me or my team if you think we can help, and I'll put my contact details in the chat. So I hope I've convinced you there are good reasons to be optimistic, and let's move forward together. And hand over to Kambourov and Andersen for the more detailed part of the webinar. Thank you.
Thank you so much, Tim, for the optimistic note. I appreciate it. Actually, one of the main reasons for optimism is that we at BBBA and outside of our organization as well, there are so many experts who can actually support the companies in going through this transition. Companies in the legal field, in the logistics field, in the consulting field, both embassies, the British Bulgarian Business Association. So the companies are not alone in these months and years going forward. And now is a very good time to have this webinar, because we can already reflect on 3 months of actual experience, because previously we were only kind of guessing what was going to happen, but now we already have a lot of information on real life examples and how companies are adjusting to the scheme. And I'm happy to say that some of our members have already shared that although the shock with the first export or import has been uncomfortable, they have found a way how to deal with it, and now they are more going into the comfort zone because it's getting into a routine. Hopefully we'll hear more and more about that. But without further ado, now I would like to give the floor to the main presenters today, who will dig deeper into the related subjects. Andersen and their collaborating firm in Bulgaria, Kambourov. Thank you so much for accepting our invitation and for involving so many senior people within the organization to talk to our participants today. I would like to ask Alexandra, as previously agreed, to introduce all the colleagues from Andersen and Kambourov that are here with us today. Alexandra, the floor is yours.
Thank you so much. Good afternoon, everyone. First of all, I would like to thank you to BBA for the hospitality and for inviting us for this event. My name is Alexandra Kalinowska. I'm a partner at Warsaw office. I'm the European coordinator of the VAT and Customs Group. And today, my colleagues from Bulgaria, Denitsa and Nicole from Kambourov, which is collaborating firm, and also my colleagues from the UK, Mais and Sarah, will present to you some practical aspects related to the business, especially how to start the business in the UK, and also we will focus on some tax, VAT and customs issues. We'll try to share with you some practical aspects, and we'll do our best to answer all your questions. However, because the time is limited for this event, so if you have any particular specific questions, feel free to contact us individually. Okay, so Miles, the floor is yours. Thank you.
Thanks, Alex, and good afternoon, everybody. I'm very conscious that we've got a lot of information to go through and not a great deal of time. So I'm Miles Dean. I am a partner in the London office of Andersen. I head up the international tax team. So I help a lot of clients, both individuals and corporates, come to the UK and set up a business establishment here. And judging by the poll, quite a large number of you in attendance today have already taken that step and have a business establishment in one shape or form in the UK already. For those of you that don't, the two main legal entities that you can choose from when coming to the UK is the simple limited liability company or a limited liability partnership. And in both cases, we have a relatively light touch regulatory environment. And we are very much open for business, as it says at the top of the slide, but caveat emptor, sort of buyer beware. There are some hidden traps really in the UK, which I'll come on to. But essentially, to form a business entity, be it a limited liability company or a limited liability partnership, the process is relatively straightforward, cheap, and there are a number of providers who are set up and specialists in this area to help you get the business entity up and running. So with regard to a UK limited company, which is probably the most widely used entity, there has to be one director, there has to be a UK registered office, it must file accounts, and so on and so forth. Now, the director doesn't have to be a UK resident, but for the purposes of ensuring the company is resident for tax purposes in the UK, and more importantly, can obtain a certificate of residence in order to claim treaty benefits, there really must be at least one director. And if there are several directors, a majority of those directors must be resident in the UK. I've had a number of situations recently where limited companies have wanted to request a certificate of residence to claim the benefits of a particular double tax treaty. And that's done on an application basis to HMRC, our tax authorities. And there's a degree of pushback in issuing certificates of residence if it isn't clear that the company is actually physically resident and operating from the UK. Our current rate of corporation tax is 19%, which is very low. I think it's the lowest within the G7. Unfortunately, in my view, as a result of the sort of reaction to the COVID pandemic, the recent budget saw that the government intends to raise the corporate income tax rate to 25% over the next 2 years. I think this is unfortunate given the timing, given particularly Brexit, when whilst we shouldn't be positioning ourselves as a Singapore on sea, as many feared that we would do, I think that's a fairly significant rise in the tax rate, which in my view is unfortunate when we should be really aiming to be as competitive as possible. The PSC register, this is for persons with significant control. A fairly significant amount of data has to be handed over and kept on a public register. Some clients are happy with that, some clients are not so happy with that, but that needs to be taken into account when setting up in the UK. Next slide, please. So the second option is a UK limited liability partnership. Again, simple and easy to operate and incorporate. It is a separate legal entity, but it's tax transparent, a bit like the US LLC, if you like. These structures have been sort of widely used, and some, including myself, might say abused over the years, in that they've been used as a tax avoidance vehicle. And this is achieved by, or has been achieved by, having a UK LLP with non-UK members, and those non-UK members would generally be an offshore company or two, and provided that there's no business carried on in the UK, the profits are not subject to any UK tax and flows through the the LLP as a transparent vehicle. Now, I think in most cases, if you're thinking of setting up in the UK, you're likely to go for a UK limited company, in which case the headline rate of tax, as I've said, is 19%, due to go up to 25%. Now, the practicalities, I've touched on double tax treaties and certificates of residence. The big problem at the moment in the UK, and it's not just the UK, and it's not because of Brexit, I've encountered this everywhere from Hong Kong to the US to Cyprus and Switzerland, is the opening of bank accounts. Now, a company, a business entity simply cannot operate if it doesn't have a bank account, and ideally the bank account of a UK limited liability company or LLP would be in the UK, and it is taking a tremendous amount of time to set up new banking facilities for clients. So that really does need to be taken into account. In my experience, it's anywhere between 3 and 6 months, which isn't ideal, but unfortunately it's the way where we find ourselves. Next slide, please. I've said here, holding company is simply the best. When I first started out in my career in tax, the simply the best category was the Netherlands. The Netherlands always had the best holding company regime. Over time, and because of I suppose influence of the OECD and the European Union, the Netherlands has changed its focus and its tack, and has kind of lost that mantle of the best place to set up a holding company. I strongly believe that the UK really is one of the best places to set up a holding company, or if you're a Bulgarian headquartered company, an intermediate holding company for EMEA or particular jurisdictions around the world. We have a very wide-ranging dividend exemption, so dividends received from subsidiaries are generally tax exempt. We have a substantial shareholding exemption, which is effectively an exemption for gains realized on a sale of a subsidiary company. Importantly, we have no withholding tax on outbound dividends. That's irrespective of where the recipient might be. So in many cases, we find UK companies with Jersey, Guernsey, or BVI parent companies. There's no withholding tax on dividend payments out. Importantly, given Brexit, we have a very significant, well-negotiated DTA network, double tax treaty network. And that's important because having left the European Union, we no longer have access to the EU directives that once applied. So the parent subsidiary directive and the interest and royalties directive no longer apply. So to allow payments of dividends, interest and royalties, we now have to rely on the treaties that the UK has negotiated. And thankfully, we have a very large number of those, and they are generally well negotiated with low rates of withholding tax. But from a practical point of view, obviously English language is the international language. Our legal system is based on common law. We have a very well regarded judicial system, dispute resolution. So when things go wrong, as they often do in commercial transactions, there is a very good support network, if you like, in the UK, ranging from the courts through to the lawyers and such like to help arbitrate when things do go wrong. We have a next slide, please. As I mentioned, in response to COVID and the financial position that the UK finds itself in, the last budget, which was earlier this month, announced that our tax rates, corporate income tax rate, would go up to 25% by April 2023. Now, this doesn't apply to companies with profits below 50,000, and only applies to companies with profits in excess of 250,000. In between those two, there's a graduated effective rate of tax. We also have new loss carryback rules and a so-called super deduction, which are intended really to get companies to start spending again in light of the financial difficulties and trading restrictions that have been imposed upon us by the response to COVID. Thankfully, there's no change to the holding company regime and no change to the withholding tax position. I should also say that if you're an individual looking to come to the UK, we still have a very beneficial regime for non-domiciled, i.e. foreign nationals coming to live in the UK. Whilst there's been changes to that regime over the years, thankfully that wasn't touched further in this budget. Next slide, please. Okay, I think this is over to you, Sarah.
Thanks, Miles. Afternoon, everybody. I'm Sarah Shears, and I'm the head of VAT for Andersen UK. So in terms of the VAT changes, obviously the UK is no longer part of the single market, and we'll come on to some of the customs and border piece shortly. And from a VAT perspective, so whereas previously, if you moved from the EU to the UK, it would be an intra-community acquisition. It would now be an import, and import VAT would be due. So the term importer of record is the term that's used for the party who's legally responsible for the VAT and customs process. It could be the buyer or the seller, and it's typically handled in the terms and conditions. Often companies, if they were solely trading between the EU and the UK, may not have had to look at this before as it didn't matter. What we're seeing in practice is that lots of customers, so lots of UK customers are worried and are asking the seller to be responsible, which is leading to non-UK entities having to set themselves up to make imports into the UK. And so you need to get an IORI number in order to be able to clear customs. Without that, the goods won't clear customs and there can be fines and penalties, and the freight forwarder won't pick up goods without it. So that's a unique number that identifies you with the customs authority and is needed to import and export. A UK business actually will sometimes need 2 IORI numbers, so a GB number to import into the UK, but also for importing into the EU, you'd have an EU one also. And you can get that when you apply for a UK VAT registration. Just on another practical point there, similar to Miles is saying with the bank account, if you're trading in the UK or have a UK company, or you're about to set up a UK company and you now need to VAT register and didn't before, there is a real backlog with HM Revenue and Customs for VAT registrations at the moment. So I have a number of clients who applied for UK VAT registration in December that still haven't come through. HMRC tend to process these on a first in, first out basis, and I think are currently working through their November applications. So you can get your IORI number when you apply for UK VAT registration. That one's a lot quicker and typically takes 7 days. And the key point here is to get a customs broker or a freight forwarder to help with this import process. And you need to make sure that you have the right commodity code in place so that you pay the right duty and don't overpay and don't get penalties and interest on that. So any import of record bringing goods into the UK needs to pay import VAT, and you can avoid the cash payment with a UK VAT number using postponed VAT accounting. So what that means is you get a postponed import VAT statement once a month where you've opted to postpone the import VAT through the customs clearance paperwork. So that's done on that customs paperwork. You then opt to postpone the import VAT and you get your certificate which shows all the VAT on the customs declarations that you haven't paid at the border, and then that goes on the UK VAT return. So each statement shows the total import VAT postponed for the previous month, and it's a similar statement to the old C79. Again, on a practical perspective, these statements are available to view in the first half of the month, and they're only available for 6 months from the published date. So they need to be downloaded and kept a copy in the records, and it's accessed through the CDS custom system For anyone who's still on the Chief system, you can apply for a CDS login for the postponed VAT accounting monthly statement. So just a quick note on Intrastat. So after the end of the Brexit transition period, businesses importing goods into Great Britain, which is the UK minus Northern Ireland, and we'll come on to Northern Ireland again in the customs section because there's a slight hybrid situation for Northern Ireland. So anybody importing goods into Great Britain from the EU is still expected to prepare a monthly Intrastat report if they're over the 1.5 million reporting threshold. This will only apply for 2021, but UK businesses exporting goods to the EU will no longer be obliged to prepare Intrastat, and Northern Ireland movements to and from the EU will be required until at least 2025. So the reason that HM Revenue and Customs is retaining the import Intrastat obligation is so that it can track import data. And as the UK will allow importers to defer import customs declarations between 1st of January and the 30th of June 2021, they're continuing Intrastat because that's viewed as essential for the UK to monitor imports. So if we could just move to the next slide. Yeah. So in terms of VAT on services, there is generally less disruption for a UK business selling services. I know Tanya did mention it was an issue that is seen quite a lot. So if I just kind of cover the general points that are seen. So typically unaffected from a kind of B2B perspective. Some business to consumer B2C services are affected, such as architect and design. So if prior to Brexit, it was a UK to EU supply, local VAT may now need to be charged. And MOS, the mini one-stop shop, that is another area of change. So previously, businesses had the option to register for VAT via the mini one-stop shop to collect and report VAT on sales of telecommunications, broadcasting and digital services to consumers in the EU. So the UK, if you had a previous UK MOS registration, this can't be used anymore. You would need a new MOS registration in the EU, and EU digital sellers would need to get a new one also if trading. And businesses would need a separate VAT registration for the UK if they're supplying these services to UK consumers. So another reason why people are needing to VAT register and adding to this backlog with HMRC. And the other point on services, if you're supplying services from the UK that come under use and enjoyment rules and are effectively used and enjoyed outside the UK, then they will be outside the scope of UK VAT now. Business to consumer supplies of a professional, technical and intangible nature. If you're supplying these types of services from the UK B2C, then that treatment has now changed. So typically the service will be seen as supplied where the customer belongs. So a B2C supply of professional services from the UK would now be outside the scope of UK VAT. So next slide, please. And I'll hand over to Kambourov and Partners now.
Hello, thank you for joining us today in this webinar. My name is Nikolova and I'm part of Kambourov and Partners Tax Consulting, and I'm responsible for the area of international tax and transfer pricing. So if I may ask, yeah, the next slide. In this part of the webinar, we will cover, sorry, I was just informed that the connection is bad, so I'm gonna switch from headphones to microphone. Can you hear me now?
Yes,
okay.
Perfect.
So in this part of the webinar, we will cover the following topics. Basically, how the EU legislation is no longer applicable in cross-border situations involving entities established in the UK. We will discuss the double tax treaty between Bulgaria and the United Kingdom, concretely in terms of taxation of income of interest and dividends. And we will conclude this part of the presentation with the transfer pricing obligations for cross-border restructurings post-Brexit. Next slide, please. With Brexit, official EU treaties and general principles of EU law are no longer applicable to the UK. And The withdrawal impacts withholding taxes on interest, royalties, and dividends paid by associated companies resident in the EU member states. And in short term, from corporate tax perspective, we'll see the following changes. Can I ask to move to the next slide? One of these changes is the fact that, as already mentioned by Miles, the Parent Subsidiary Directive and the Interest Royalties Directive will no longer be applicable. And generally, the purpose of these instruments is to eliminate withholding tax for profit distributions between group of companies in the EU, as well as interest and royalty payments within a group of companies arisen in the EU member states. However, as Mel said, the UK is a country that has a very rich tax treaty network, and an example of that is in fact the double tax treaty signed between Bulgaria and the UK, which provides for even more competitive tax outcome than what was provided in those directives. So if I may ask to switch to the next slide. So there are other directives that are also not applicable post-Brexit, and it's worth mentioning the fact that the directive on tax dispute resolution is no longer applicable, and in case of, for instance, double tax issues that have arisen between Bulgarian taxpayer having operations in the UK and in Bulgaria, remedies have to be sought under the mutual agreement procedure that is enshrined under the Bulgarian-UK tax treaty. And the problem with that is currently the article, I think it was 25, requires the competent authorities to endeavor to reach an agreement and doesn't impose an obligation. So we'll see in the future whether this will be amended, and let's see that the competent authorities from both countries undertake steps in this respect. And last but not least, the merger directive is no longer applicable in cross-border mergers involving companies incorporated in the UK, and therefore the tax benefits that were provided in the said directives would no longer be applicable. We can move to the next one. And despite the fact that these directives are no longer applicable, we do have a very good tax treaty between Bulgaria and the UK, and we have provided two examples in the following slides, namely how we tax income from dividends. And as a general rule, dividends paid by a company that is either resident in Bulgaria or in the UK might be taxed in the resident state. However, such income might be taxed in the source state, meaning in the state where the interest is paid, but it is exempt if such income is paid to the beneficial owner, which is either a company resident of the other state or in a pension scheme. 15% taxation is applied on dividends that are paid out of income derived from immovable property by an investment vehicle that distributes most of this income annually and whose income from such immovable property is exempt from tax. And in all other cases, we do apply a 5% rate. If we can move to the next one. In terms of interest, interest arising in either Bulgaria or in the UK and paid to a resident of the other state may be taxed in the resident state. However, the interest income can also be taxed in the source state, but if the beneficial owner is a resident of the other contracting state, the rule is that the tax shall not exceed 5%. In any event, the double tax treaty provides for certain exemptions, such as exemption from taxation in connection when interest is paid in connection with the sale and credit of any equipment, merchandise, or service. We do apply exemption on interest on any loan not granted by a financial institution, pension scheme. And here is the interesting point, how actually the treaty does provide more beneficial treatment than what was stipulated by the parent subsidiary and the interest royalty directive. So here we do apply an exemption for interest paid between companies where ownership is at least 10% and the ownership is held for a period at least 1 year. And this provision actually covers the situation of interest paid by a subsidiary of a subsidiary. So if we can go to the next slide, please. In any event, it's worth mentioning that many businesses have undertaken restructurings in light of Brexit with the purpose to enable regulated businesses to continue accessing the EU market. And such business restructurings can create a number of tax impacts. And where businesses transfer functions, assets, or risks from a UK entity to EU one with the purpose to enter the EU market, then the associated valuation, exit tax, and transfer pricing implications need to be assessed. And therefore, we advise you and our clients to determine whether the cross-border transfers of business activities do trigger a taxable event and associated valuation and exit tax position. We further advise to review the impact of Brexit-related business changes on transfer pricing policies. And last but not least, consideration should be given to the interaction between transfer pricing and customs valuations for intercompany movements of products between the UK and the EU. And to that, this puts an end to my part, and I would like to give the floor to my colleagues, Sarah and Alex, who will present to you the new UK border controls and customs procedures.
Hi. So as I said, so prior to 11 p.m. UK time on the 31st of December 2020, the UK was part of the single market, which meant we had 4 fundamental freedoms: the freedom of movement of goods, people, service, and capital over borders. And the UK has been part of the single market since 1992 and part of the customs union since January 1973. So now there's no freedom of movement of goods, and the goods can be stopped unless at the border, unless the correct paperwork and approvals are in place. So from the 1st of January 2021, traders importing non-controlled goods have had to prepare for basic customs requirements, such as keeping sufficient records of the imported goods. They also need to consider how to account for and pay VAT on the imported goods, which we touched on before. And traders have up to 6 months to complete customs declarations. So there is a delayed declaration. That declaration does need to be made. So that doesn't take away the requirement to have to keep those records in place and keep funds aside to pay anything that's required. It's just that the declaration itself has been delayed. So while tariffs will be payable where due on relevant goods, the payments can be deferred, as I say, until it's made using a duty deferment account. UK safety and security declarations are not required on imports to Great Britain from the EU for those first 6 months as well. So we are almost halfway through that first 6 months now. Full customs declarations, though, are needed for controlled goods and excise goods, for example, alcohol and tobacco. And there are physical checks at the point of destination or other approved premises on all high-risk live animals and high-priority plants and plant products. Export declarations and UK exit safety and security declarations are required for most goods, and traders importing and exporting goods using the Common Transit Convention will need to follow all of the transit procedures, and that part of the border changes are not introduced in stages. So I'll hand over to Alex for the EU approach to the border. Next slide, please.
From the EU perspective, the international trade between the EU and the UK is similar to the international trade with other third countries. However, there are some specific rules, and generally speaking, all imported goods from the UK are subject to customs control. And there are 3 lines set up at the border: green, orange, and red line, depending on the types of goods. And of course, there are some goods subject to sanitary or other sort of controls, which has to be performed at the border, and traders who are going to act as importers of records from the UK are obliged to apply for EORI number and to register for VAT in the EU. And also in most of the EU countries, the operators from the UK are obliged to set up an indirect customs representative because for customs declarations, customs clearances made for the entrepreneurs from outside the EU, the customs broker can act in its own behalf, in its own name and on behalf of the trader. And some of the customs brokers are requesting a guarantee to cover potential customs duties and import VAT. And very important aspect, in order to apply 0% customs duty rate, the goods imported from the UK have to qualify for a preferential origin. And this is very important because some of the goods can be produced outside the UK and they do not qualify for this preferential origin. And in such a case, they are subject to customs duty. So it is important when planning the supply chain and so on, because it could be the case that if, for example, goods are first imported from Asia to the UK, and the customs duty will be paid in the UK for the first time. And when we move those goods to the EU and they will not get the preferential origin, they will be subject to customs duty once again. So, of course, in the EU, there is a possibility to apply for the simplified customs procedures and so on. Regarding exports, I will give the floor to Danica. Danica will explain you more in this subject. Thank you.
Hello, everybody. For those who don't know me, my name is Danica Dimitrova. I'm a tax partner in Kambourov and Partners Tax Consulting. And I will just add a couple of practicalities because I don't think that Bulgaria differs much from the other European countries in terms of exports. And after United Kingdom became a third party, the rules that currently or has been applied to third countries are still valid and apply also to UK. There are three points which I encountered as important from a practical perspective. One of them is how we prove from Bulgarian perspective the zero VAT rate upon export. And I would like to confirm that the rules applicable to third countries now apply also to the United Kingdom, and the exporter should possess a customs declaration or other customs document where he's indicated as exporter. Otherwise, Bulgarian VAT should apply as a general rule. Secondly, we just discussed with Alexandra before the conference, and I think that she touched already the point about the rules of origin. So I'm not going back to that point. And the third thing which we found important is about the certificates of conformity. So yes, they should change, and they should be prepared based on the rules applicable for exports. So if you have any questions, particular questions related to the export requirements from Bulgaria or EU to the United Kingdom, just feel free to ask them. And since the time is running, I'll leave back the floor to Miles. I believe he's the next.
I think we're on the home stretch.
Yeah, next slide, please.
Next slide, please.
Oh. Just a quick one from me before Miles on Northern Ireland. So Northern Ireland, as I mentioned, has this kind of hybrid situation. So whilst it's kind of part of the UK, and it's also sort of treated as Europe for some of the rules. And this is it's been quite a tricky thing to navigate, and there's quite a few issues that we're currently seeing in practice, moving goods from Great Britain to Northern Ireland. And in fact, only last week, the European Commission sent a letter of formal notice to the United Kingdom for breaching the substantive provisions of the protocol on Ireland and Northern Ireland, as well as the good faith obligation under the withdrawal agreement. So that letter last week marked the beginning of a formal infringement process against the United Kingdom. So this has been a difficult area to negotiate. So under the Northern Ireland Protocol, the UCC, VAT legislation, excise duties legislation and commercial regulation is applicable in Northern Ireland. And the UK is supposed to ensure the application of those regulations. So from a customs perspective, goods imported through Northern Ireland are subject to the UK tariff, provided the goods are not at risk of an onward movement to the EU, and goods brought into Northern Ireland from Great Britain are not at risk if the tariff applicable is zero, or it's possible to claim the application of a preferential rate. The UK and the EU tariff are equal or similar, and if there's a difference of more than 3 points between the two tariffs, then the goods will be considered at risk and will be subject to the EU tariff. And if the goods are for sale to or for final use by end consumers in the UK and are brought into Northern Ireland via a trader authorised under the UK trader scheme. And that's one thing where we're seeing is holding things up and delaying as well, making sure registrations are in place for the UK trader scheme. So if you're moving goods between Great Britain and the Northern Ireland, then please feel free to reach out and ask for our help. And now I'll pass back to Miles.
Thank you, Sarah. Next slide, please. Thank you. So DAX 6, as I've lightheartedly suggested at the top of this slide, that the UK has actually been ahead of the game since 2004. And by way of background, the UK had, for many years, a rampant tax avoidance industry where government incentives were often taken and turned into tax avoidance schemes, packaged and sold very, very significantly, leading to a huge amount of tax loss, a lot of litigation through the courts. And the one thing that was evident was that the tax authority, HMRC, was often behind the eight ball, so to speak. It was often reacting to the scheme providers who were always one step ahead. So in 2004, we introduced what was called the disclosure of tax avoidance schemes, which was, I guess, a precursor to DAC, the sort of mandatory disclosure regime within the European Union. And basically, the DOTAS, like DAC, acts as like an early warning system for the authorities, so that arrangements put in place by agents or intermediaries, mainly tax advisors, but also banks and other third parties, if they contain certain hallmarks, such as fees that are linked to percentage of tax saved, or are pre-packaged, or have certain loss-making features to them. They are the hallmarks which are then disclosed to the tax authorities, and it allows the tax authorities to track those taxpayers that have utilised these types of scheme. Now, DOTAS continues to exist in the UK for domestic transactions, but because, again, we've left the European Union, the UK will implement legislation to apply the OECD's mandatory disclosure rules instead of DAC 6. Now, the effect of this is that there's a significant reduction in the extent to which DAC 6 applies in the UK, and until the OECD's version is implemented in the UK, our obligation really is limited to Hallmark D, which is basically arrangements that undermine reporting obligations, involve non-transparent legal or beneficial ownership, and offshore entities or structures with no or economic substance. Now, this obviously is a relief for UK-based tax advisors, but of course, where there is an EU-based advisor on a transaction involving a UK party, they will obviously have the obligation to report and exchange information in respect of a transaction with all the hallmarks. So whilst from a UK point of view, the burden is much reduced, it doesn't change at all for EU-based advisors where there's a UK element. Next, please. I have to confess that immigration is not my particular area of practice, but I've highlighted some of the sort of key changes that I think are potentially of interest. As Tim mentioned at the outset, the settlement scheme is still open for individuals who are resident or present in the UK prior to 30th of December 2020. We're helping a number of clients through the UK office at the moment in utilising this scheme, which is actually works quite well. There's a significant amount of paperwork involved. It's all sort of online and relatively automated, but it works well. So individuals who have been in the UK prior to the 30th of December, you've got 2 or 3 months left to get settled status, which has to be a significant benefit. Business visits to the UK. If we go to the next slide, just for 1 second. Oh yeah, so from 1st of January 2021, freedom of movement between the EU and UK is no more. Obviously, EEA and Swiss nationals can continue to travel to the UK for business-related activities on a short-term basis. Now, short-term, I think, is generally held to be less than 6 months, and business-related activities are attending meetings, events, and conferences. But there are very, I think, fairly strict restrictions on what can be done, and excluded activities would include carrying out paid or unpaid work for a UK company or as a self-employed person. And I'll come on to self-employed in the context of the new IR35 rules in a second. Carrying out a work placement and selling directly to the public. Now, let me just move on to, if we can just go back to the previous slide. I'm sorry, thank you. As I think many of you will know, that we now have a points-based system for skilled workers in the UK, and the kind of main features of this are that the individual has to have a job offer from a Home Office licensed sponsor. The job offer is at the required skill level So they have to have various sort of minimum qualification thresholds. The applicant must speak English to the required standard. And there are also salary thresholds that have to be met too. Now, the points-based system, the individual has to achieve a total of 70 points, and the government has quite helpfully printed, or there's a table on one of the government websites setting this out. And there's the offer of a job by an approved sponsor, for example, carries 20 points, job at an appropriate skill level, 20 points, speaks English at a required level, 10 points. And then there's all sorts of other features that will apply in given circumstances. And if the individual reaches 70 points, then they ought to be granted the right to work. Next slide, please. Next slide, sorry. Okay, so the IR35, this really looks at the IR35 is a revenue sort of guidance on the use of personal service companies by individuals. So contractors, for example, often use companies that they own to provide their services. And the IR35 rules were introduced many, many years ago in the UK, and they're designed to combat disguised employment situations. And by that, I mean that but for the interposition of a personal services company, would the individual be classified as an employer, as an employee for UK tax purposes rather than a contractor? Now, prior to April 2021, the contractor was able to self-assess, but after a lot of consultation, the burden now shifts to the end user, who has the burden to determine whether the individual that they're using as a contractor is actually a contractor or an employee. Falls on them. Now, if the end user determines that that IR35 applies, the responsibility for operating PAYE, that's deduction of tax at source, and application of national insurance contributions, falls on the fee payer, i.e. the end user. Now, the rules don't apply to most small end users, and a corporate end user that is not part of a group will be treated as small in its first financial year and will remain small until it ceases to do so. And small companies will become a medium or large company and therefore brought within the rules if at least two of the following conditions for 2 consecutive financial years are met. And the conditions are that the annual turnover is more than 10.2 million, balance sheet total of more than 5.1 million, and more than 50 employees. Now, if those thresholds are not met, then the old, or the rules as is now will continue to apply. Again, the way in which you need to determine whether the person you're using is a contractor or an employee looks at various, again, hallmarks: control and working arrangements. How much control does the end user have over the contractor's hours and place of work? I mean, these basically look at the badges of employment rules that we have in the UK. The right of substitution: can the contractor send a substitute? Mutuality of obligation, integration into the business, i.e. how involved is the contractor in the business and its management, and various other factors. So there is a significant burden now on the user of contractor services to ensure that they get it right. And helpfully, HMRC has what they call a CEST tool on the internet, which is Check Employment Status for Tax. we love an acronym in the UK, and certainly tax advisors love acronyms. So as I said, that there is a tool on the internet that I've certainly used in practice to see if it spits out the right results, and yeah, that's there for everybody to use if they need to do so. Next slide, please. GDPR. Again, this isn't part of my day-to-day practice, but as at January 1st, 2021, EU GDPR ceased to apply directly in the UK, but it has been incorporated into UK data protection law. So in practice, my understanding is that very little changes. Next, please. Well, there you go. You can see I've got COVID hair, judging by the picture on the left-hand side. That concludes our presentation. I think we've gone a bit over our time allocation, but I hope you found it very interesting. Certainly talking with Sarah, Alex, Denitsa, and Nicole, I think we view the state of play in the UK challenging at the moment, but I think we remain optimistic in terms of certainly post-Brexit and the environment in which we find ourselves sort of calming down. And certainly the work that Sarah is doing with Alex and Denitsa on trading operations between the countries, or Bulgaria and the UK, hopefully that will settle down and things will become easier. Of course, we have the fallout of the COVID pandemic to deal with, and I think that may be more of a concern, certainly in terms of the economic environment that will play out over the next 2 to 3 years, and the effect on our employment and financial figures. So I think there's a lot of challenging times ahead, but we certainly feel very positive nonetheless. But thank you very much for taking time to join us today. I hope you found it very interesting.
Thank you so much, Miles and Sarah, Alexandra, Denita, Nicole, Tanya, Tim. You have been outstanding and covered so much information within exactly 87 minutes. I'm glad that I saw a lot of dynamics in the Q&A section, and the questions that we received have all been answered in writing. Maybe if there are still some open questions, if you still want to take the last couple of minutes of the webinar to go through them, the floor is yours. One other question just came in. I have a frontier worker status, employment contract with UK entity paying taxes and social security there, but have no NIN due to the process that requires to be present there. Is there a way to apply online distantly?
Yes, I believe there is. I think traditionally one had to have an interview with one of the sort of government employment offices, but I believe there is a possibility to do that online now. To get I think the question relates to national insurance numbers, NINOs, and if that's the case, then yes, it can be done online. And if the person's asking that question wants to get in touch with me, I can certainly get one of my colleagues to assist.
Okay, thank you, Miles. Let me just go very quickly through the other questions. I think, Miles, there was one for you about the Ir35 regulations, but you already commented on that in your presentation, right?
I did briefly, yeah. And if there's any more specific questions that anybody has, then again, more than happy to discuss those either now or offline via email.
Great. There was a question regarding UK Revolut bank account, which apparently is sufficient for establishing an LLC subsidiary.
Yeah, I mean, there's no, there is no requirement to have for a UK limited company to have a UK bank account, nor is there a requirement to have a traditional bank account in the form of a high street bank. So yeah, Revolut or Starling or one of the other kind of new fintech platforms is sufficient. I suppose the question then becomes, from a perception point of view of the counterpart that's being asked to settle an invoice into a bank account of Starling or Revolut, what does that look from a perception point of view? And it's not really anything to do with tax or anything like that. And there's certainly no obligation, as I said, to use one of the sort of main high street banks. And actually, it's a very good point that's raised. Actually, the requirement to operate and trade commercially is such that in this day and age, and the way we find ourselves, that more and more clients setting up in the UK will be forced to use these new platforms, because it's just certainly not feasible to wait 3 to 6 months for one of the big banks to make up their mind as to whether they're open for business or not.
Thank you, Miles.
I appreciate that's a long-winded way of agreeing with the question.
Thank you, Miles. One more question just came in regarding returning sold goods from the UK. What should be the correct procedure? Maybe Alexandra or anybody else?
The goods which are sold from the UK to the EU, right?
Yes.
Okay, so those goods have to be declared for export, customs clearance in the UK, and in the EU, they should be subject to import customs clearance. And depending on the contractual arrangements, the importer of record in the EU can be EU established entity, or if the UK exporter sells goods based on delivered duty paid, on DDP in Incoterms, then the UK exporter has to perform also import customs clearance in the EU. And in order to do so, the UK entity has to apply for the EORI number in the EU and to register for VAT in order to be able to deduct, yes, the import VAT through the VAT return. And in some of the EU countries, there is additional requirement to establish the fiscal representative, but maybe from the Bulgarian perspective, Danica can comment on this fiscal representation.
Well, yeah, we discussed already with BBBA the issue with the fiscal rep. We didn't touch this point because fiscal rep is needed only for companies which are not established in Bulgaria, and they have only VAT registrations, but they're established in the UK. I think that probably most of the attendees know that according to the last changes in our legislation back in December 2020, British companies which were currently registered in Bulgaria, at that time were registered in Bulgaria through simple VAT registrations, now have to appoint a fiscal representative. The truth is that the policy of the Ministry of Finance in Bulgaria for many years was that all countries who are participating in the OECD Convention for Mutual Assistance in Tax Matter, companies registered in those members of the conventions were released from the obligation to have fiscal representation in Bulgaria. But now with Brexit and with this last change in our legislation, they introduced again this rule, and 15th of January was the deadline for the distant sellers registered in established in the UK, and 31st of March for the rest of the British companies. And actually, the impact is not only to British companies, but also to companies established in all other third countries, because we had numerous conversations with the revenue authorities, and their answer was that this change was invoked by the European Commission, and they promised to provide a list with countries for which a fiscal rep will not be required in the future. However, for the time being, this will apply for all third countries. We still expect to be provided with an official answer on that. So this is just verbal communication with the authorities, as we submitted an official inquiry in January to get an answer on that question. And we're still waiting for it. The message from the authorities, from our Ministry of Finance, was that the European Commission promised to provide by the summer of such a list. What I know from you, Alex, is that Poland decided to release Norway and United Kingdom from fiscal rep.
Yes, correct. Yes, and maybe one more comment regarding those goods, because when I read this question, maybe it was related to return goods. Yes, so if the goods are exported from the EU to the UK and they are returned back, there is a special customs arrangement. It is called returned goods. And then you can apply for the customs duty and VAT exemption.
Okay, that was the simpler answer, I suppose. Thank you very much, everyone, for your brilliant work today. It was very interesting for me personally, and I'm sure for all the participants. Thank you for going deep into so many topics and managing to do it within an hour and a half. Of course, the conversation doesn't end with the end of this webinar. So I would urge our participants, if they have any questions that come to them, please contact us. You have our contact details, the British Bulgarian Business Association, and we will be happy to refer your questions to all our panelists today, and I'm sure they will respond in due time. Thank you, everyone, for your time and expertise. Appreciate it, and wish you a very good evening, and hopefully happy spring, and hopefully the good weather will be with us very soon. Bye-bye. Have a good afternoon.
Thank you very much, Desi.
Thank you. Bye-bye.
Bye. Bye.